On today's episode, we are going to take a look at three airlines: Southwest, Delta, and United Airlines. And these companies have dropped a lot since the weekend just because of Warren Buffett's comments about the airline industry and how he sold out of all his airline companies. So let's get started. Today's episode is actually going to be pretty cool. We're going to get a lot of information from all these three airlines. So we're going to take a look at companies' balance sheets, at companies' future PE ratio, valuation, news article about the companies, and we're also just going to take a look at the overall airline industry as well. So I hope you guys enjoyed the episode. Don't forget to hit the subscribe button, the thumbs up, and the bell. It helps the small channel out so much. And let me know, what are your thoughts about Warren Buffett's sell-off? Did you guys also sold some of your airlines? Are you guys buying some more airlines? What are your guys' thought process right now? Make sure to let me know in the comments. And finally, thank you guys for the support. I truly appreciate every one of you guys that takes the time to watch my videos. It means a lot, so thank you. All right, so first, the main piece, right? So the main article comes from Buffett after he did his Berkshire Hathaway meetings this past weekend. I think it was Saturday. Buffett explained that his firm has exited all of its positions in the airline industry. But he did mention that he doesn't want investors to take this sell off as necessarily as a speculation that the shares will go down lower. Right now, he's just not really seeing much of an upside on these companies, especially with them taking billions in federal aid as the coronavirus wreaks havoc on business. And you know, this to me is pretty much like a self-prophecy. For example, Warren Buffett sold off his stock. Because Warren Buffett and Berkshire Hathaway sold off their positions, people are prophesizing that this means that the stock price are gonna go lower. So they begin to sell. And because they begin to sell, more people begin to sell, and the process continues, and eventually all this volume of selling brings down the stock price. So for me, it does become a form of self-prophecy, of self-induced prophecy. So next, let's take a look at the overall market in the air travel industry. For the month of May, a lot of companies have already reported earnings this past 2 weeks. They have Delta, Luv, and I think United Airlines have all reported their earnings. One thing they're mentioning is that April was a pretty weak month for them. April, they saw somewhere between 90 to 95% less customers, less traffic compared to the same time last year. That's pretty much having close to zero traffic in the airline industry, and that's pretty crazy. And United, this was just reported on May 1st. United sees 2 months of 90% flight cuts. So for the full month of May, they see another 90% drop down in revenue in traffic compared to the same time last year. So we can see why these airline industries have taken a big hit, right? Just because that huge impact of traffic in the airline industry has dropped down to near zero values. But there are some good news also on today, May 3rd. Actually, this was yesterday, May 3rd. The Southwest Airlines CEO says that the worst of the pandemic is over. He says that he doesn't think June will be good, but it will be better than April and May. Like I mentioned, in April, they saw almost 95% decline in traffic. So they were running at 5% traffic. Each week after the first week of April has gotten better. And May at the moment continues to get better compared to April. And right now things, even though they're not as good as nowhere near as good as where they were, they are getting better each week. And he did note that even though it's good that they're seeing a lot more booking in June, it doesn't really say much because we don't know where the whole COVID-19 is going to be by in June. And all these airline industries are making it easy for people to cancel their flights. So a lot of people are just booking flights assuming things will go good. But if things are still bad, they're going to end up canceling those flights. All right, so the first company we're going to take a look at is Southwest Airlines. And Southwest is one of my favorite companies out of all of them. Like we're going to see, this one has the best balance sheet. And I think that's going to help this company a lot. So right now, Southwest is sitting about $27.56. And today it dropped pretty low. I think most of these companies dropped about a 9 to close to 10%. But throughout the day, they got things got better for them. Throughout the day, right, this company went up about 5%, about 4% from its lows of the day. So right now, if we take a look at the past 6 months, let's just take a look in February 20. So compared to February 20th, this company has dropped about 51%. So half of the total valuation of Southwest has pretty much been cut off in just the past 2-3 months. So next, let's take a look here and see how revenue has been affected by this company. So all these companies that have reported earnings have reported a net loss for this quarter. And if we take a look at this top chart that I have right here, we can see that the revenue for this past March was a lot lower compared to just two previous quarters. You see that big decline. But one thing you don't see, if you see this blue graph is the cost of revenue. Revenue itself took a big impact, but cost of revenue barely dropped, and that's what's really affecting these companies. And even though they're not collecting revenue, their cost of revenue is still pretty much kind of a hard cost of revenue, where even if they don't have much flights, they still have a lot of things to pay. So that's what's causing these companies to report a loss. So here, just compared to same time last year, this company's revenue dropped about 17.7%. So close to 18% decline compared to same time last year. But cost of revenue only dropped by about 10%. So revenue is dropping at a faster rate than cost of revenue. So that makes that more money, this company ends up burning more cash. Next, let's take a look at Southwest balance sheet. And here I took away one of the biggest assets for these companies, and this property, plants, and equipment. So I really only want to take a look at cash and cash equivalent and current investments. This is cash that this company is able to liquidize pretty quickly. At the end of the day, this does not include uncollected credit. So if this company has a credit line, it does not include it in here. But right now, this company has close to $6 billion in cash and cash equivalents, right? It has about $4 billion in cash and cash equivalents and about $1.6 billion in current investments. So that's about 5.6, but let's say about close to 6. And now let's take a look at this company's current debt. This company has current debt of about $3.13 billion. So in theory, this company has enough cash to pay off all its current debt for the year. So that's actually pretty good. It means that this company is able to survive, at least when it comes to debt. There's other types of liabilities, but right now we're just taking a look at that. Then let's take a look at this company's non-current debt. So non-current debt is debt that needs to be paid off longer than 12 years. So this can be broken down in 2022, 2024, 2026. So just any time from 12 months from now. This company also only has about $3.22 billion of non-current debt, which again is not that horrible. This company pretty much has not exactly, but it has close to a 1-to-1 ratio of cash to current debt plus non-current debt. Maybe not as close to 1-to-1, but it's the closest compared to all the other companies we're gonna see. So now let's take a look at Southwest Airlines daily cash burn. So this company burns about $30 to $35 million a day. So let's say 35, and each quarter is about 90 days. So let's say 35 times 180. This company in 2 quarters from now, in 6 months from now, would need about $6.3 billion of cash to make sure it won't go under. And like we saw, this company has definitely close to that cash and cash equivalents at hand. So in theory, this company is not going to go anywhere for the next 180 days easily. Again, there's other things, but it's just a quick way to see how things are going. And this is how we're going to compare the other companies as well. So finally, we're here in Seeking Alpha, and I just want to take a look at forward PE ratio for this company. For December 2020, this company is not expected to make any money. And in theory, no airlines are going to be making any money for this year. But for December 2021, this company is expected to make $2.38. $2.38 at the current price. Let's take a look. So the current price is $27.56 divided by $2.38 gives this company a PE ratio of 11.57 on future estimates. Now let's take a look at what this company's PE ratio usually tends to be. So this company tends to be 12.6, 10.8, 11.7, 14.3, and 13.0. So I want to say easily somewhere between 12.5. So with a 12.5 PE ratio and what was it, 2.38 times 12.5, this company, I would consider it undervalued anywhere below $29.75. That doesn't mean anything above that is means it's a bad investment. For me, anything below $29.75 I would consider undervalued compared to its historical values. Again, this is not advice, this is just my opinion. All right, so next we're going to take a look at Delta stock, and Delta stock was down about 6.5% for the day and is sitting at $22.57. If we take a look in February as well, this company has lost a little bit more value compared to Southwest. It has lost about 61.4% of its total valuation, so close to 2/3 of its valuation is gone in just 2 months. So just like Southwest, this pretty much tells pretty much the same story, right? This is for the most recent quarter one. We see a huge decline of revenue, but we don't see a huge decline of cost of revenue. So this cost of revenue for this company is pretty hard coded. That yes, it might drop a little bit depending on less flights they do, but there's still so many other expenses that it really doesn't make such a big impact. Revenue for this company also dropped about 18% compared to the same time last year, while cost of revenue only dropped about 9%. So we're seeing a bigger impact of revenue itself than cost of revenue. Now, if we take a look at this company's balance sheet, it's like I said, I think Southwest has the best balance sheet, but Delta does not have one that's too bad. So this company has about $6 billion in cash and cash equivalents and about $0 in current investments. So pretty much this company has about $6 billion at the moment. First, let's take a look at this company's current debt. So this company has a current debt of $5.11 billion. So in theory, this company can use its total cash and cash equivalents to pay off its current debt. But after that, this company will be short in money for its non-current debt. This non-current debt of about $18 billion. So we can see, right, even Southwest had a way better balance sheet, right? They had 3.94, which was more than enough to pay off current debt, and then they had an extra 1.6 plus whatever they had left over. So they had an extra close to $2 billion after paying their current debt. So they had an extra $2 billion. Well, Delta, if we take a look at Delta, once they pay off their current debt, this company only has about $800 million left over for the rest. And that's where I can see a lot of people are more bullish on Southwest than on Delta. Next, we're going to take a look at Delta's cash burn rate. So Delta burns about $100 million a day, and it's expected by the end of June to be burning $50 million a day. So let's do an average of $75 million. So 75 times 180, this company needs about $13.5 billion. Again, that's way more money than it has, and it's way more money than Southwest needs to survive. So you can see how this company has a less likelihood of surviving. I'm not saying any of these companies are gonna go under, but the percentage of them not making it or having to do dramatic changes to get that money becomes more effective as the more cash they need. So it does seem like Southwest will be able to survive with the amount of cash. Unfortunately, Delta would not. In theory, with the amount of cash and cash equivalents that Delta has, it should be able to survive at least the next 90 days. But on some good news, this company has applied for $4.6 billion in federal loans, and they're also raising more money and expect by the end of Q2 to have about $12 billion in cash. Next, let's take a look at Seeking Alpha, and this company is expected to make $3.90 for the year of 2021. And let's take a look at the current price of $22.57 divided by $30. What was it? $3.90 gives this company a forward PE ratio of 5.8. Now let's take a look at historical PE ratio. Normally this company seems to have a forward PE ratio of about 8.8, I would say. Let's do that. 3.9 times 8.8 gives this company a forward price of $34.32. So in theory, this company is a lot cheaper than Southwest, but it comes with a huge risk, right? We saw that this company has a lot less cash and will be able to survive, in theory, less amount of days. So what could end up happening is that this company might have to sell off some planes, might have to close down some airports and some lounges in certain airports, might have to shut off some routes. And this, at the end of the day, can end up dropping that earnings per share. So right, with the more money you need at hand, the more dramatic things that you might have to do to change that. So with higher reward at the end of the day also comes higher risk. In this financial world and anything in life, there is no free lunch. Finally, we're going to take a look at United Airlines. United Airlines ended the day at about 5% down. And when we take a look at the price compared to February 20th, which is what we were looking with everything else, this company is down close to 70%. And as we can see, right, Southwest dropped 50% and it had the best balance sheet. Delta dropped 60%. It had what I consider the second balance sheet. United has dropped 70%, and which is I consider one of the worst balance sheets out of the three. So we can see how even investors know which ones will survive the most just by seeing that decline in valuation of the company. So some quick articles. First, on April 22nd, this company did a public offering of 39 million shares sitting at $26.56. So obviously you are a better investment if you wait it now, because now you can buy it even cheaper than that offering. The second thing is United Airlines sells 22 planes to Bank of China Aviation. So this is actually just what I mentioned with Delta, right? United Airlines has the weakest balance sheet that we're going to see. So it needs to do dramatic changes. And one of the things they had to do is sell off 22 planes to the Bank of China, and that can dramatically affect the amount of revenue, the amount of earnings that this company makes throughout the upcoming years. So if we take a look at revenue, this company's revenue dropped again about 17%. And one thing I forgot to mention, you guys might be like, wow, these airlines only dropped 17% of revenue, things are better. No, this quarter only lasted for the last two, the coronavirus impact pretty much only affected the last 2 weeks of this company's industry. So imagine if 2 weeks dropped down made you cause a 17% drop. Imagine months and months within a quarter. So we know April is going to be weak and May might be pretty weak. So they expect revenue to drop down about 90 to 95% compared to same time last year for quarter two. And here we can even see cost of revenue only dropped by 6%. So even though revenue growth dropped by so much, cost of revenue again dropped only by a very small number. Now, if we take a look at this company's balance sheet, here, this company for the most recent quarter only has about $5.3 billion in cash and cash equivalents. This company has current debt of about 4.8, so it has enough cash to pay off its 4.8 its current debt, but then after that this company has a non-current debt of about $18.63 billion. It's not as good as Southwest, like I said, has the best, but it's not too far off from Delta. Now let's take a look at this company's burn rate. So this company is expected to burn a daily cash of about $40 to $45 million for the quarter of 2020. So let's say 45 times 180. This company needs a lot less cash than Delta to survive. But again, remember, this company has had to do a lot more to be able to have some form of cash, especially by selling those 22 planes. Now, if we take a look at this company's forward PE ratio, you would see the forward PE ratio for most of these companies continue to drop lower and lower as investors believe these companies have a less likely chance of becoming back to the giants they were. So investors are more confident in Southwest, they're okay confidence in Delta, and they seem to be barely non-confident on United Airlines. So this company for 2021 is expected to make $5.65. With the current price, I can actually see it's going to give me a forward PE ratio of about 4.8. So 4.8, and let's take a look. In theory, this company usually has a forward PE ratio of about, we can say about 8. So with $5.50 times 8, this company has again the highest reward if it goes back to historical valuation. But like we said, right, each of these companies have different balance sheets that can make these companies a little bit more riskier than the other, and with more risk comes the chances of more dramatic things being affected. Like I said, United sold 22 planes. That's actually pretty crazy. So that's it for today's episode. Let me know what you guys thought. Make sure to subscribe, make sure to give the thumbs up, and make sure to hit the bell. I truly appreciate the support from you guys. So take care, have a good night, and see you next time.